Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for June 27th, 2022. We are recording this at 1 p.m. Eastern Time, and this is episode number 384. My name is David Kosmeter. I'm the creator of TimingResearch.com, and today I've arranged for the option professor to be here to do a solo market outlook episode for us. So he'll be starting in just a second, but also want to remind you, in case you haven't seen this, we had a big event this last week. We had 3 different dedicated days. On Tuesday was options trading, Wednesday was currencies trading, and Thursday was futures trading. So if you have not had a chance to check that out yet, just go to TimingResearch.com and you can scroll down and see the full archives from that event there. So a lot of good presentations and a lot of good education from a lot of professional traders. So be sure to check that out. And now I'm going to turn it over to the option professor.
Okay, thank you very much, David, and welcome everybody on this Monday morning. There's going to be a lot of action this week, I'm sure, and there was certainly a lot of action last week. Quick introduction, the option professor, we are in the business of investing here for decades, so we're very familiar with all different types of investments. We've given seminars throughout the country and even worldwide on the uses and risks of options. And so we have extensive experience and knowledge in the area. We're going to share that with you here today. With regards to what I share with you today is going to be my opinion and my observation. So let's be clear that anytime you're actually thinking of investing, you should go and talk to your brokerage firm who can discuss with you suitability and your risk tolerance. And nothing today is going to be an actual recommendation to anybody. So this is, again, for informational purposes only. Okay, so now having said all that, let's get started and see what's going on. First of all, I'm showing you a long-term graph on the S&P. And today we're going to go over a wide variety of investments. So you guys who are out there looking at different markets, we're going to cover each one of them more than likely. So hang with us and get the information that could help you. With regards to what you're looking at on the screen, I'm showing you the macro view on the S&P 500. As you can see, going back 20 years, there's 3 different averages that we use up there and a relative strength index. And here's the situation that you're looking at right now on the S&P. We came down and tested the long-term moving average. You can see in the last 10 years, since 2009, this average has been rising. So no coincident that the market has been rising as well, right? Because this is based on price. So you can see it's a rising market. You just hang with it. It got violated here and when? Back in 2016. And then it boom, right back above the line and on its way it went. Again, it got violated here in 2018 when they were doing all that hiking in Q4 and the stock market dropped 25%. Bam, only for a little bit and then right back above it. So again, the direction of the blue line is very important. Now you've had a big drop during the COVID crash, but again, within a month, the Fed was printing tons of money and we're right back up again. Right now, we just broke it again. We broke it in the month of June, this month, and we went down to a low of 36.36. Then the average is coming in at 37.17. And so we're back above it. And as we talk to people who listen to us and get our stuff, we said, once you got back above it, you want to get back in here. And now we've had a 200-point run off of that number. Not a bad thing to look at and not bad insight from the option professor. And we're very proud of our insights. So again, at the end of the broadcast, we'll explain how you can get them. All right. So anyway, we're looking good right now. And now it's had a big advance. Okay. What the problem here is that if it starts getting back underneath 37.17 for whatever reason, your RSI now is down to, where is it at? It's at 48. RSI under 50 is not a good deal. So you want to get that RSI back above 50, and that'll preserve the long-term trend. If not, it can open up that door to that 3,400 number, which was the high that Trump got back there in 2020, right before the crash, that could serve as support. So we would anticipate you possibly are going to get a move down there ultimately if the Fed gets anything near their goal of 2% inflation. Because to get the 2% inflation, again, we've been around here for decades. We know that two things occur when you want inflation to come down. What happens? The economy slows and unemployment goes up. And both of those things are not good for earnings. Okay, so anyway, and then of course, the outside chance is to come down to these highs here, which are the highs back in 2018 before we had the drop, and that is in the 3,000 area, somewhere plus or minus 3,000. So if we do break the 3717 and you are sitting there like Buddha waiting to get smacked, that's why we have the PDF report on what? How to hedge market declines and protect your money. But also we have how to hedge against upside surprises. And while this upside move is no surprise to us, it's a surprise to many of you maybe, and ergo you could have taken a strategy to hedge against this. We go over that in that PDF report. Okay, so there's your scenario. We dodged a bullet when we broke under 3717, and now we're back above it. Okay. Now, again, if we do start breaking back underneath there, it'll open the door for potential down to 34 and 3,000. If they cut earnings, if earnings are cut instead of go up, you could be looking at a situation, and the multiple, which has already come way down. We were at 21, 22, 23 PE ratio on the S&P, and right now at $2.30 earnings times 17, you're at 39.10, which is right where we are. So you're at 17 times earnings. What if we go to 14 times earnings? If we did that on an overshoot, now you're looking at $2.30 times 14, and now you're looking at 32.20. So that's how we get down to those lower numbers. The PE ratio is compressed further, or the earnings at 230 either stay or come down. Okay, so we'll have to see what happens because earnings are going to start coming out in the next few weeks. So keep an eye on those. But again, if they're going to get down to 2% inflation and we're at 8 or 10% or wherever the heck we are, 20% in real estate, you know, they're going to have to slow things down, and slow things down means jobs are lost and earnings get tagged, generally speaking. Okay. All right. So having said that, I just wanted to show you the QQQs, because that actually did penetrate, I think, its long-term average. So that can show you, and sometimes that's the leader. So the bottom line is on the Qs. It broke the average pretty nice, just like the other one did. Let's get this thing off the screen here. Okay. And then it got back above it. So again, where's the Qs? It starts closing under where? Q starts closing under 290. And you're back in the soup on, and then your RSI is at 45. So the RSI doesn't look great on the Qs. And yeah, again, I'm noticing yields are rallying again this week. We're up about 7 points on the 10-year. And, you know, if the Fed wants this inflation to come down, you know, they may want to see, you may see higher rates if the market does rally. Okay. But right now, and the red line up here pointing down is not a good sign either. You can see that's about as much as the red line's been pointing down in a while. So even if we got a big rally, getting above that 360 mark might be very tough. But that's a pretty good rally from here to there. We'll have to see how things go. But again, that's what it looks like on the Qs. And then on the small caps. So I'm giving you 3 different bites at the apple. You got the S&P, right? You've got the tech, right, in the Qs. And now you got the small caps, and small caps really went way underneath the average, and the small caps RSI is way at 42. Now this is the long-term picture. I'll show you the short-term picture on some stuff in a minute, but again, the big picture is that red line is pointing straight down, and that red line is not the kind of thing you want pointing straight down if you're bullish. Okay, so again, we could chop around while the red meets the blue. Those meaning the 12 SMA meets the 36, that's possible. But again, you also still have the possibility, and you can see we've already come down to the 2018 numbers and the 2020 numbers when we went down towards 160. So that was not a bad place if you want to take a shot right down there, because you had a support there and you had a support there. But again, we'll have to see if this thing can have that bear market rally. When they say bear market rally, the red line's pointing down. So until you get that above that red line and the red line starts pointing up, looking for a bull market could be like looking for Godot. Okay, so that's where you are on there. Now I'm going to go back to the S&P, and I'm going to show you some short-term charts that we use that gave us a good inclination that this rally was going on. Okay. First of all, we had that 37.11, 37.11, 37.17, because that number is moving. It's a moving average. So it gets higher as long as we stay above it. But I'm going to show you on a short-term graph here a couple of things I'm happy about and not so happy about. So let me show you. Okay, what was I happy about? I was happy about on the 1 month graph that we turned up the red line right here at 3,700 ballpark area. And basically that's where you get the short-term buy signal. RSI gets above 50, right? That's a good thing. And you get above the red line, and then the red line starts pointing up. So that on a short-term basis, that's your buy signal. You buy in. And as long as it stays right now above 38.61, you're looking pretty good. If it starts getting under 38.61 and that red line starts pointing down, then we could get something that looks like this for all we know. Okay. But again, I'll show you on the 3 month graph what we're thinking here. Okay. You see, when we had the rally before Memorial Day, right? It got above the red line and the red line was pointing up. And you got a nice rally from the low of 3,800 all the way up to 4,200. That's a 400-point move. You got on the train realistically here at around 39.50. Because that's when the red line started to turn up. Red line hasn't turned up here, okay, and it's pointing down, and the RSI is at 48. So this is pretty much a crunch time for this thing because you want it to stay above 38.06, okay, and you want this red line starting to turn up, and you definitely want that RSI above 50 if you're thinking that we're going to get this action again. Now, the entire planet is looking for a rally going into July 4th. I mean, the butcher, the baker, and the candlestick maker, they're all saying, even the bears, we're going to get a rally going into the holiday. We're going to get a rally. I mean, you know, that's great. But you know what? If this thing starts fading and can't get above this 39.50 number, and this RSI starts pointing down, then what we saw on Memorial Day will not be the same. So let's see how this week goes by. And here's the problem. We've got news coming up this week. Today, we got durable goods orders. That was supposed to be coming down. It was way higher than anticipated, and it was a broad advance. Now, that's not the direction for durable goods as far as the Fed is concerned. So that's a problem. The 10-year note went back towards 320. 320 is an important area. In fact, I'll show you a chart on that in a minute. If the 10-year note starts getting above 320, I don't see that as positive for the stock market. So keep an eye on that. Now, tomorrow, Tuesday, we have consumer confidence coming out from the conference board, which is a little bit of a broader gauge of consumer confidence than the Michigan one. And then we've got a trade balance coming out. We've got on Thursday is the big day. And that might be the thing that turns us one way or the other. It comes out where we have income and spending. So we got personal income and spending, but we got the PCE, which is the personal consumption gauge that the Fed stares at because they think it's the best gauge on figuring out really what inflation looks like. So that's going to be a big thing coming out. And we also got jobless claims. Friday, we got some ISM numbers and we got auto sales. Okay, but Thursday is the big kahuna because of that PCE report. So we have to keep on that. That comes in hot again, you know, then we're going to blow through 320 on the 10-year and we're going to get going. Conversely, I'll show you in a minute on the interest rates. We do have room to go down if things started to really look like, you know, they were easing off. But that durable goods report is a big yellow flag. You know, that's supposed to be coming down. We're supposed to be done with the refrigerators and the washer, dryer, and, you know, the things that last for 3 years or more. Okay, we're supposed to be down with that, and we got a broad advance today. So that's a surprise. And surprises to the Fed, since they're trying to get to 2%, and the highway is looking like 8 or 10%, to get that traffic to turn back down is no easy task. So that's the problem. And the Fed uses words like unconditional commitment to getting it down, and there could be a recession. And they use a lot of language that doesn't sound like they're going to back off. Because here's the thing: if they don't hike rates right now and get this thing under control right now, then that stuff that happened with Volcker could come back into play. Which means if it gets totally ingrained into the system, and if it stays out of control, they'd have to take even more aggressive interest rate tactics and more aggressive draining of reserves in order to get it down. They're trying to avoid that. So the way you avoid that is you get it hard, you hit it fast, and you cool it off before it gets way out of hand. Now, obviously it's out of hand because you're $9, $8 on gasoline, and the food prices have gone nuts, and the houses are up 25%, and it's already gone nuts, but it could get even more nuts if it doesn't abate. And that's what they're trying to avoid. So remember that when you're looking at things as far as that's concerned. Okay, so that gives you a little idea of what we're looking at. Yes, we are thinking there could be a rally going into the holiday. There's no question about it. And I'll show you some charts that would give you an idea why it could do that. It's just such a popular opinion, and I don't like the way this thing is set up with the red line pointing down and not moving up. And I don't like the RSI at 50, and it could roll down in a minute. And if everyone bought like crazy, last week, and obviously they did, if they, hear or start seeing the thing starting to fold like a lawn chair, and, they find out that there's no bids for whatever reason, then, these high frequency traders will nail that side. Now, there's a lot of things positive going into the end of the quarter. Window dressing, that's where the managers look at the portfolio, and they're going to have to hand in their quarterly portfolio, and they may do what? They may get rid of some of the losers and paint the tape a little bit with what? Some of the winners. So there could be some rebalancing by sovereign wealth funds and pension plans, rebalance the stock and the bond portfolios. That could be helpful. You also got buyback potential coming up, and you've had some insider trading that have shown some buying. So you've got some positive flows that could help. So again, we don't want to fight the tape. We don't want to fight, but we don't want to fight the Fed. And I don't know that the Fed's going to have a party hat on if this thing starts going nuts on the upside, because that's not going to kill the wealth effect. That's going to just continue to add to it. And consumers, like I say, they've been held in by COVID. So, they want to go out and do revenge travel, they call it. And, they may want to keep going on the spending front. The credit card numbers are starting to show that they're hitting the credit cards, and the savings are going way down. So, they are unloading their surpluses. But anyway, so that's where I'm concerned as far as the markets are concerned. Like I say, I would love to see that red line starting to turn up and start to look like it did before we had the rally into Memorial Day, which we caught as well, as you can see. Okay, so that gives you a little bit of an idea on the stock market and a little bit of an idea of what's going on there. Again, I did an analysis over the weekend, and if I look at the 1-year graph, things like, I'll just show you, people are saying the oil market, but you step in front of this thing here and you are looking for a rally. It's got a good one here, but it's still got that red line pointing straight down. And so could it run up from 70 up to 80? That's a good run. So I guess that could be a nice bounce, but the RSI is way under 50. And so, on a short-term basis here, you could get a rally, but, if you notice, when the thing gives you big gains, it doesn't look like that. So there's your oil, and then some of your servicers and stuff like that. Schlumberger. I'm going to go over different sectors so you get a flavor. Again, very oversold, could certainly rally, but RSI looks like garbage. And again, like here, it did rally out of the blue, but was it so bad for you to get in here at 40 rather than 38 and then have the red line pointing up? Because, we generally don't go through the roof if the red line's pointing straight down, so there's your Schlumberger. And what about Halliburton? Okay. Yeah, Halliburton, same story, right? It fell into the abyss. I mean, everybody's telling you get into energy, get into energy. Well, if you got into energy last month in May, excuse me, if you got, even we're in there in June, you're getting killed. And these people are calling it a safe place to be. That doesn't look safe to me. That's why we follow the charts. We don't listen to people on TV. I mean, what do they know? Right. So the bottom line is, you got to follow the trend. You want to be bullish on it, get bullish, when it's down here, get bullish when it's on this big rally, get bullish after it makes a low and then goes back up. But the lines look like this. This is just throwing it against the wall and hoping it sticks. It could stick. I mean, like I say, I wouldn't be selling it here necessarily because obviously it's already dropped. But playing it for a bounce, can work out. But I don't like that look. To get real serious about it. Again, it bottomed out at 30. If it's going to go up to 40, this red line is coming in at 34, 34 and change. So let's get it above 34 and change. So you'll give up a few points. But if it's going to 40, there's still 6 on the table. And if it's going up to 42 to fill these gaps here, there's more on the table. But at least it'll look like the trend has turned, not just throwing it against the wall going, yeah, I think this is a good spot. I mean, that's a rough way to go. All right, so there's your energy markets. Let's look at tech here. And we're going to look at, let's look at Google because they're splitting 20 for 1. And anybody who bought the 20 for 1 on Amazon wasn't very happy afterwards. So let's take a look at Google. Okay, so Google on a 1 month basis has probably turned up, and it has. And obviously, where'd you get the buy signal here? It started turning up 2160, and then you let it ride. Okay, what about on the 1 year? 1 year, that's pretty darn flat on that on the red line. And again, you're just barely above the 50 mark at 54. So again, you got some resistance up here maybe, but this thing, these things do look like they're trying to turn. Let's just see what happens here. Maybe it's just going to spike up and try to go up to 2650 on a crazy market run. Anything can happen. And right now, if you're long, you definitely want it to staying above 2250 basically and 2200 using 2 round numbers, 2200 and 2250. Definitely want to stay above those 2 numbers if you're looking at Google. We talked about the Amazon split just to show you what happened after that happened. I think it was at 140 when it split. And you can see when the split occurred, it happened within the last month or so. And you can see, it was in the 120, 130 area, whatever, 130, came all the way down to 100. And then basically it's back on the bicycle here. You got your buy signal 106 and you're riding it right now. Now I'll show you where that 100 came from. I think it was on the 5 year. Well, yeah, here's the 100. You see these highs here, and remember, I'm relating to you when you're looking at charts. Look at the highs of 2018 and 2020, because some of these markets are coming down to them. So that's why you're bouncing. Okay, so 100 was a great place to take a shot because you're trading against these highs. So on all your charts, my suggestion is look at your highs on 2018 and 2020, and you might want to trade against them. Now, again, this thing still looks like it's in a total down market, but it could have a rally, and maybe it'll even get into the window here of 140 and 155. Okay, if things really get hairy, everyone starts going, get in, and you start seeing the 10-year note going underneath 3% and something like that. Yeah, you could get a rally into that region for sure. And again, right now, if you're long the stock, again, we say we'd like to keep this thing above what? 110, 112, 113. Okay, keep it above there to get these averages to turn up. Again, do you notice what I'm saying here? When we got the rally going into Memorial Day, again, the thing was turned up, and we don't have that right now. And that makes me a little concerned. The other thing is the RSIs failed right around that 54, 55 area and then came back down. Well, we are just at the, we just hit, where do we hit? Right here, right around the 50 area. So again, this is why, the whole world is pounding. We're going to rally into July 4th. And I'm saying, not so, hey, what do they say? Not so fast like Lee Corso does on football Saturdays, right? Hey, not so fast, right? But yeah, so that's what I'm seeing here on some of that stuff there. Okay, so let's look at the banks. Now, the banks are going to be the first to announce. Is there a deal here or what? Let's find out. Again, what's the good news on the banks? The banks had a stress test and they all look like they have a lot of money. What's the problem is the yield curve could invert the 2 and 10. The other thing is when you did all those refis and you got your 2% interest or 2.5% or 3% interest on your loans, they might be holding those mortgages. And what happens to mortgages when interest rates go up is the value of the mortgages go down, like any other debt instrument. So they have significant losses from that possibly on their balance sheet, but they're going to have net income, right? From net interest income that is supposed to jump 15 to 20% this year because of the rise in interest rates. Because don't forget, when you put your money in the bank, they don't pay any interest, right? So what do you think they can do? They can take that money and earn interest on it, right? So again, there's a good story in the banks from the standpoint of the net interest income. Is a good story that the consumer is not defaulting on their debt and they are using credit cards, and commercial people might be doing some loans, and that may be enough to offset the bad mortgages as far as the value of the mortgages because rates rose. We'll have to see. We'll have to see. But again, as far as the trend is concerned, you see the red line is still pointing down and the RSI is under 50. And that's not really the setup when we had the rally going into Memorial Day. So that's why I'm still caveat emptor, a little buyer beware right now. Again, if you're trading on a short-term basis, you got a buy signal. You got a buy signal down here at 31, right? It's trading 32. And like I say, if it can stay above the red line, which comes in at 31.76, only 50 cents away from where we are now, you might have something going on. And this is, of course, the big banks. Let's look at the KBE, I think it is. Yeah, this is, I think, the more regional bank one. And let's see what the regionals look like. Yeah, they've turned up as well. I'll give you one that I've been following that has had a very big move last week. It's a regional bank. And I will give you the symbol on that right now. It's UM. Hang on here, UMPQ. Now it's down today, but you'll take a look here. It went from 1580 to 1740 in 2 days. So obviously this is a reason why people play the regional banks sometimes. And this regional bank certainly had a pretty good move. Let's look at the 1 year on it. And again, the 1 year has the thing right there on the ledge. I mean, the market is really right on the ledge as far as I can see. And I would probably look at the 10-year note. It starts trading 325 or 330. I think this thing will come back down. It starts trading 315, 310, so anywhere near 3 again. Then I think you probably get a nice rally. That's probably not a bad thing to keep an eye on. The 10-year Treasury note yield. All right. Just going to run through some of the other, shall we say, stocks that got hit, that got cheap. Palantir, give you some of that. Go into like some of the tech stuff here. Okay. If you look at the 1 month graph, you had a nice buy signal on it. Right down here at 780. All right, the red line turns up. That's when you get in. And right now it's testing it. So you had a pretty good run. It went all the way to 1020. So there's a 50% move on your money in just a very short time. That's why we follow these graphs. Next one is Roblox. There's another one that gave you a nice buy signal down here at 27 bucks, ran all the way up to 37, another 30% gain. And now as long as it stays here above that 34 number, again, it's still on the up. Okay. Another one we were looking at was Unity Software. This one gave you a little buy here at 34 bucks, ran all the way up to 47. It's testing it here right now, but a nice little run. So some of these beaten down ones, they had a pretty good snapback rally. And so sometimes that's the thing to look at. Okay. Some of the other ones that people are starting to tout is they think that the infrastructure story is going to come back, right? So basically, they're trying to look at these industrial metals and see if there is something that is going to turn here. So this is you got a buy signal here right at 2250, and it is rising. Okay, on the 1 year though, again, things pointing straight down, and it comes in right where we are, and the RSI is under 50. So again, the jury's, as far as I can see, the jury's still out. And like I say, if it gets above the 23.5 area and it's on its way to fill these gaps, there's still plenty of room up here. But if for whatever reason, it's not going to be able to have the strength to fill in these gaps, you could dodge a bullet by being a little patient here. Okay, so again, if you're trading it short term, you've got a line in the sand here with the red line coming in just under 23. As long as we stay above that, that would be nice. Your RSI is above 50. So short term traders, again, we look at the 1 month, but again, the 1 month can turn quite a bit sometimes. So you have to be a little careful. I like to see at least the 1 year confirm the 1 month if you think you're really going on any significant run. And right now, the 1 year is really not confirming the 1 month. And that's why, we have the yellow flag up. Again, if it's going to just go through the roof like a maniac going into the 4th of July, then none of this matters. You just buy anything you want. But again, we like to use the data rather than just pin the tail on the donkey. Okay, let's look at some of the gaming stuff because they started to pop a little bit too. Is this Macau going to open up, and are these Chinese people going to go back to the tables? If so, Las Vegas Sands would be something to keep an eye on. So again, you got a little bit of a buy signal here at 31 on the short-term graph, and it gave you a little bit of a pop. But the problem is on the 1 year graph, again, it's still pointing straight down, and the RSI is right on the ledge. So again, getting above the red line is the first step. Now you've got to sustain above there so you can turn the red line up like it did going into Memorial Day, where it got above the red line here and it turned up, and then you got a nice run up towards 38. Okay. Again, the RSI is quite a bit higher than it was during these lows. So that is an indication that the selling has dried up a little bit down here. Okay. So again, this could be a lot of potential. So again, if it can get above 34 and stay there, it starts taking out 38. They start going back to the tables. This red line starts looking like this. You could make some money. So you keep an eye on that. Domestically, a lot of people have been talking about Caesars. And Caesars, again, a lot of them have the same look, right? RSI is just under 50. Red line still pointing down. So the first thing is you get above the red line. That's a good thing. But again, there is a lot of room for this thing to go if it ever turns. So being patient and seeing if the trend will turn up is not the worst thing in the world. On a short-term trading basis, I'm sure you got a buy signal. You got it down here at around 39, 40 bucks. So some of the gaming stocks, Penn Gaming and Red Rock, RRR, and MGM Grand, they are starting to try to make a turn. A lot of that travel stuff, got nailed. Supposedly all these people are at the airport. So everybody goes, hey, we better buy the airlines. Well, let's see how that worked out. Okay, this is just a 1 month. In 1 month, it's gone from 20 down to 16. That's a 20% loss on your money in 1 month. That's by buying these hot airlines, right? And on the 1 year, it's even worse. Thing ran up to 23, went all the way down to 16. That's like a 40% drop. And the chart, again, still pointing down, and the RSI is still under 50. So again, definitely you can see a bear market rally can take you up here, no problem. But when we got this back before Memorial Day, at least the red line was pointing up. We don't have that just yet. Now we could have it by the end of the week. So you got to keep monitoring it, and this thing updates every day. So basically, that's what and then there's a thing called Away that gets you into the hotels and all that kind of stuff. And again, it's getting above the line, but it's still got room there. If you're a short-term trader, you probably got a buy signal already. Hey, your buy signal come in about $18, but nothing to really write home about. The one that everybody is shocked at how much they're losing on is Airbnb. I'm going to talk about hedging a little bit here because that's what we were supposed to talk about, and something I'm familiar with for the last 30 years. New to many people, not new to me. All right, so you got a 1-year graph here on Airbnb, right? And everybody is saying Airbnb is going to be going up, and it looks fine. It's up at $210, and that's in November of last year. Then it comes way down, it goes back up here. Okay, right up here, you had an opportunity when it was up in the 170 neighborhood. Once the red line starts turning down, okay, that's your money going in the toilet. Okay, so rather than having your money go in the toilet, what some people do is do some hedging tactics. Now, what are hedging tactics? Well, one of them could be what? The market is rolling over here, and you go, you know what? This looks like it could go south in a big way. So why don't we sell the 170 calls or the 180 calls and take that premium and buy a 150 put? So now if Airbnb goes up to 170 or 180, I can still make some more money. And if it goes under 150, I've got the right, but not the obligation to sell at 150. So everything under 150, I'm protected. And the darn thing went to 90. So that wouldn't have been a bad thing to do. The other thing you can consider is a replacement trade. And a replacement trade is where you dump your stock and then you buy your 175 or 180 calls, probably fairly cheap. Go out 6 months or a year or whatever you want to do. Now you've got a hedge in case it goes through the roof. Maybe that cost you $5 or $10. You're taking out 170, you're putting in $5 or $10, and now the rest of your money's in your pocket. So when it goes down to 90, all that money in your pocket is a lot better off. That's why we have the report on hedging downside risk and upside surprises. Because right now, if you are out of this stock, you might not want to do what? You might not want to buy it because the whole trend is still down, but you might want to take something to hedge yourself. And when would you hedge yourself? Well, you might hedge yourself when the short-term trend turns up, which is right here at around 96. So if you're a believer that this thing has potential, but you don't want to actually buy the stock, you could take a limited risk strategy on the options. And we always suggest that you price out the far out options because those sometimes are not that much more expensive for the amount more time you have. And sometimes we do call spreads where you buy one option, sell another. Again, when we have a one-on-one session with somebody, we can explain these strategies because these strategies are not right for everybody. And the thing you definitely need to know is what is the risk of the strategy? Can I get called away on a covered call, or could I roll the position up, or what can I do? And again, you have to talk to your brokerage firm. What's suitable, what's in your risk tolerance window, and what is not. Okay, but the strategies themselves have to be understood, and that's where we try to help. With regards to, again, what you're trying to do with these strategies is quantify your risk a little bit. Either you have a limited risk option or you have parameters around your stock, upside potential, downside risk. Because if you don't have parameters around your stock, then you're kind of like a feather in that Forrest Gump movie where it just floats around and that's your equity. Sometimes people are not comfortable with that. So again, this is a stock that's a good example of supposed to be doing great because we have all these people traveling, but for whatever reason, it's having all kinds of trouble. Okay, so there's your travel situation, just to give you an idea. Give you an area that we've been very keen on, and this is one of them. And we've been telling people to check this out for 2-3 months, and we'll show you why. Again, China is in lockdown, right? So that means they've actually taped the doors of apartments so you can't get out. That's pretty good lockdown, right? So at some point, they're going to be unlocked down. And these people probably are going to be like our people, want to get out there and spend some money. Also, China did not print $9 trillion during the COVID problem. So they have a money to ease money and credit now while everybody else is tightening. So that might be helpful as well. So that's why we got into a buy signal down here in May. And again, we don't buy it down here or down here. We try to wait for the red line to turn up and then we take our shot. So again, right now we're into this stuff, and 29 and 30 was the signal, and we certainly would like it to stay above 31, 32, and about 33, and hopefully it'll be able to keep going. RSI looks pretty good right now as well. So is there potential here? Again, if they're going to obviously not invade Taiwan, and if they're not going to again, a lot of the reset has already been done in China, meaning they already got all their corporations down. Right? They all took Jack Ma and his talking out of turn and quelched that. All their billionaire, trillionaire people have, lost their money because their stocks have come down. The greater good, right? That's their theory, and I think the reset had been done. So that's why there's an opportunity here, possibly, and we'll follow the numbers as long as the numbers are pointing up. Those are your large cap. Also, the ones in the tech sector, they have had a turn up. In fact, this is one of the few charts that have a very good look to them. Here we got the buy signal, $25. We're already at 33. Can you see the RSI is above 50? So as long as we can stay above between 29 and 32, something like that, things can continue to matriculate to the upside. Okay, obviously this was the better time to get in when we first got the signal, but again, there could be significant potential looking forward as long as some of these geopolitical variables don't hit. And then there was another one that we took a look at that we talked about to people, which was DD. And again, the idea on DD is that I had a very simplistic point of view. I was talking to people and I said, you know what, there's how many billion? 2 billion, 3 billion, 6 billion. I don't know how many people are in China. Somebody must need a ride somewhere, right? So basically this thing here, gave a buy signal here at $1.50, right? And now we're just riding it and riding it and riding it. Hopefully it's going to keep going. The RSIs do looking pretty good. I mean, when it goes from 150 to 3, you can sell out half your position, take your money off the table, and now you own free DD stock the rest of your life, right? Because again, once a stock doubles like this, if you take half your position off, that's your original capital, right? And now you got a free look at the DD thing. So anyway, that was something I thought had some potential, and certainly it did. Right now, could it pull back? Of course it could, but the bottom line is we'd like to see these trends continue. So staying above $2 and 225 and 275, there's the numbers right there. You can read them for yourself. 281, 236, and 210. Like to stay above these numbers. The longer you stay above these numbers, these are moving averages that will continue to matriculate to the upside. But that's something we recognized. And again, using common sense, it was not a bad place to take a shot. Okay, what else do I want to cover for you guys here today? A lot of people are thinking that the ARK fund may be an indicator if we're really going to, maybe we hit the bottom at 3,600, who knows? Maybe the 10-year topped at 350, who knows? If that's the case, though, and we're going to have a big recovery, some of these things that are beaten up, look at this thing. I mean, come on, in the last year, it went from $130 down to $35. Okay, now it's above all the averages, but the averages still aren't really turning up. And the RSI is above 50, which is good. But I mean, there is a little bit of a turn here. If it can hold its water here, there could be an opportunity here. You got a double low at $35, and you're starting to try to take out this neighborhood here. That neighborhood's 47. Right now we're at 45. So getting above 47 would take out this neighborhood. And if it can stay up there, maybe this thing could start matriculating to the upside. So keep an eye on it because, they certainly have beaten it up. Anybody who's still in there, is obviously a believer. And maybe they've changed their portfolio around to prune it by getting rid of garbage and keeping good stuff. Who knows? But I do know this. That's high and that's lower, and this is trying to turn. So that's of interest. But it was trying to turn here at 70, and then it went in the toilet again. So the bottom line is that, just because it jumps up, if the blue line can't get going to the upside, this thing doesn't have a long life. So here the red line got moving up because it's a shorter term one. That gave you a nice 55 to 70 move. But if the blue line is just going to keep going down, then it doesn't last. And then boom, you go down. Because again, the direction of these averages is just as important in our view as the price itself. Okay, so we went over international, we went over the S&P and the Qs, we went over the small caps, we went over some of the small stocks that have bounced back. And now we're going to go over, and we went over the energy, and now we are going to, and we went over travel. So I'm going to go over a couple of other things here. Cybersecurity. And here you look at this one here, and it started to look like something might be going on here. So you see the red line is still not turning up, so we don't like that, but we do like the RSI's above 50. We do like it's trading above it. And so if we can get this red line to start turning up, we might be able to get going. And this is, again, a pretty good company in cybersecurity. If you want to just buy the whole ball of wax, you go with CIBR. You got to figure cybersecurity is going to be big for a long time because, these bad actors, they're not going away. So, and companies will spend money on this because they have to. But again, this thing again is still doesn't have the red line pointing up, so that's not good. And your RSI is right at 50. Again, a lot of yellow flags going into the holiday right now. We'll have to see how things break. Again, keep an eye on the 10-year note. Starts going to 325, 330. I think this stuff is going to disappoint going into the holiday. Frankly, the Federal Reserve may not want everybody to be thinking happy days are here again. So if that's the case, we might see yields jump just to put water on this thing a little bit, but we'll have to see. But again, cybersecurity, and then cloud computing is always another one because there's economics to doing it. I think it reduces costs dramatically from employee and other expenses. And so this is something that we're keeping an eye on as well. So again, it's getting above the lines, but the lines are not pointing up. But obviously both of these are in the process of possibly turning up. But again, that RSI is right around 50. So, if this thing starts fading back down, it's all bets off. So let's see how it goes. But those are two areas, cyber and cloud, that is something to watch. Okay. Last thing I'd like to go over is in these metals. All right. Because, a lot of people, these industrial metals just collapse. So let's find if there's any value there. Let's take a look at the gold. And let's analyze the gold, because believe me, something's going to happen here one way or the other. Okay, if you look at the 20-year graph on gold, this is GDX, so it's not an actual gold, it's the gold miners. And we did very well because we recognized Newmont Mining was a bargain at $55 when it was paying 4% dividend. And it went all the way up to 80. So, we definitely were bullish on these metals, but then we got off the train. Very bullish on Freeport-McMoRan, but we got off the train. Let's see if going back on the train makes any sense. Again, this thing goes on a big run. You stay with it. That red line starts rolling over, sayonara. Okay, had a little bit of a pop going into Memorial Day. And now you're looking like this going into Memorial Day. So right now, again, the 1-year graph's pointing straight down, and you got a lot of resistance at $30.31. So getting above there, it'd be important. Let's look at the 20-year graph to get the big picture. See the big picture here? You really got to get this thing back above the blue line. The blue line comes in at 32.75. If you have hopes for 35.40, 45.50, 55.60, you got to get above 35. Where are you at here? You got to get above 32.63. Excuse me, 32.75. Keep that in mind. It also comes in, look at it, it's a traffic jam. You got 32.63 on the red line, and you got 32.75 on the blue line. That traffic jam does get resolved. Okay. So If it's going to, that's a great number to keep an eye on. It starts trading above that number, you might want to put your hat in the ring, particularly if you can get this RSI back above 50. Again, right now it is susceptible to accelerating to the downside, because if it takes out these lows, there's not anything under here. And that's the same thing with the price of gold. Price of gold had a lot of support around 1,800 bucks. Price of gold gets under 1,800 bucks. It has a pretty good vacuum, a pretty good air pocket there. So keep an eye on that, because it's at crunch time. Same thing with your silver. Okay, so silver, same story, looking terrible underneath all this, red line pointing straight down. What's to like about that? Not too much. On a 1-year graph, again, not too much to like right here, except that it's at a double low. And if the thing can start getting above 29, then you start keeping an eye. 29, if it starts getting above 29.30, then maybe something might turn down here. But right now it doesn't look very good. Turn to copper. Freeport McMoran. Love this thing at $8 or $10. Didn't like it when it hit to about 50. And I will show you why. Look at the 20-year graph here, or here's the 1-year graph. I'll give you the 20-year so you get an idea why that 8 to 10 was so good. You see right there, 10 bucks, get in, right? But it starts breaking under 40, you got to respect that. And now it's at 30. Okay. Now, again, overall, the trend still looks pretty good. When would it make any sense to take another shot at this thing? I don't know, not, there's a possible rally right here, right? Maybe to 34. But, that trend is not up right now. Okay, then let's look at the steel and the metal industrials. US Steel. Again, another one that was at 38 bucks and the world was lovely. But when they turn, you get out or you hedge. Again, hedge. Basically, so it went south there. Red line still pointing down. Oversold on the RSI, but still lousy looking. Did you get a short-term buy? Maybe. Yeah, hanging on for dear life if it can stay above 19. If you can stay above 1934, you're holding out for dear life. Much better if we were above 20. RSI is fading. Cleveland Cliffs. Long-term chart, Cleveland Cliffs. Again, there you are. You're testing the blue line down here at 14.25, right? Getting back above the green line means you got to get above 18 bucks. Get above the red line, you got to get above what? 22.60. Well, why not? Like I say, if you want to play bottom hunter here, you could, but the RSI is right there at 50, 48. So again, if you wanted to try to buy the low, you could do that. But again, the shorter term graphs still look pretty lousy, pointing straight down. With regards to your 1-month graph, again, similar to US Steel, holding on for dear life at about 16 bucks. So let's see what happens here on the metals, but they are very discounted. You have to give them that. And this stuff is used for infrastructure, and it's also used when they start building cars again. So there is a future to it. The thing is the present and the recent past is certainly not very pretty, because a lot of people loaded the wagon on this stuff, and you can see why. Because in the last year, this thing went from 16 bucks to 34 bucks. But when it rolls over at 32 bucks, you must say sayonara. Okay. Or hedge it. So that gives you a little bit of an idea on the industrial metals. And if you ever want to do a one-stop shop on the metals and mining, XME is a one-stop shop. And a one-stop shop here, again, similar to obviously what's in there. very much of a down move, 66 to 44. So that was a good 30% drop. And then again, when you get a low surrounded by higher lows, if you're a short-term gambler, you could take a shot and you put your stop underneath that point, and you are getting a bit of a bounce. So if you get a formation like that, just like here, you got a high point with two lower high points, you take your shot on the sell side. And then basically sometimes you can hit it good. Again, if you get a formation like that and you can correspond it to a 1 month graph that tells you to buy in at 45 bucks, then you got a couple of things working for yourself. Okay. All right. We are at the top of the hour here. And so I just want to reintroduce ourselves. This is the Option Professor, and our website is Option, OPTION, Professor, PROFESSOR.com. Our email address is optionprofessor@gmail.com. And we've got a couple of things that we try to do for people. Now, hopefully after listening to this for any length of time, you have a little bit of an idea that I have some experience and I have a little bit of knowledge behind me as well. And obviously I have knowledge in many different areas because over the decades, I'm familiar with pretty much it all. So what I try to do is I try to create a PDF report that might help people who are not as experienced and learn about things that could be helpful to them. One thing is hedging, and hedging against declines in the market or hedging against upside surprises. We have a PDF report that goes over that in detail. We send that out to you. And also you get a 45-minute, which generally goes to an hour, but 45-minute session where I one-on-one go over some of the indicators we look at. I go over some of the option strategies. You have questions that need answers. I try to help you with them with regards to different tactics, you know, on hedging or on any of the option trading situations, like how to, you know, trade options and what's the use and risk of these strategies. Try to give you a hand with that so you're a more intelligent investor. We do all of that on one package deal. So you can go to optionprofessor.com, put your email and your phone number in there, and then we check back with you and we discuss how to get it started. And again, I think you'll be very happy on how it works. So I'm encouraging you to go to the website and put in your information, optionprofessor.com, email, phone number, and we give you a ring. If you want to shoot us an email, optionprofessor@gmail.com. One last thing I promised you before I'd left is to take a look at the 10-year Treasury, which is really, you know, Reggie Jackson used to say he was the straw that stirred the drink for the Yankees. Well, the 10-year Treasury is the straw that stirs the drink for stocks. And let me explain why. Because this is the cost of money. And I'm going to show you something here that you can see. 20-year graph. That is a historic low, grand cycle low on interest rates. That's 1/2 of 1%. If the cost of money goes from 1/2 and 1% up to 3.5%, don't you think that would change the valuation of stocks and the valuation of other things like real estate and other things that's dealing in borrowed money? Well, my common sense teacher in college said it would. And it has. So there you go. There's the culprit on the drop. There's the culprit on your valuation compression. And that's going to be your culprit on slowing the economy down and slowing GDP and causing 3.6% unemployment to go back over 4 and then some. So there you go. Now, on a short-term basis, things are a little different. This thing's had a big run. We have a little bit, you see right now, the RSI hit 50 and it's pointing up. So that means these rates could start rising again, and the stock market's not ready for that. So that's why I told people in the newsletter that we want to stay under 323. The longer you stay under 323, you can get that red line to turn down. But see, these lines are rising interest rates. And if we get back above 323, remember I use 320, it's really 323. Then this market is not going to like that. So if we jump above 323, that's not going to be good. If we can get down back to 3 or break under 3 and ever break under 275 here, 270, then we have seen the high in interest rates, and the second half of the year could be very good for stocks, just like Tommy Lee and old Marko Kolanovic keep pounding the table. But right now they have no evidence of that. And so I'd like to see some evidence before I cast my vote. So keep an eye on this baby. We get above 323, no bueno. We get under 3, good for the stock market. Under 270, fantastic for the second half of the year, because then the valuations could maybe expand. I don't know what's going to happen. I'll be following the numbers. If I was a guessing man, the Fed does not want low interest rates and these prices to go nuts again. So, I don't like to fight the Fed, but I'm not going to fight the tape either. We're at the top of the hour. This has been the Option Professor of OptionProfessor.com. Again, I'm extending an invitation to contact us. Get the PDF report on hedging downside risk and upside surprises. And more importantly, discuss how we could get together and give you some help on better understanding the trends of markets, but also understanding how the options work. We have extensive experience. At the optionprofessor.com, you'll see a little background on myself as well. Okay, so it's great to have you with us. It's the top of the hour. I got to sign off. We definitely look forward to hearing from you. And of course, with Timing Research, we're always around. So you'll hear from us again. But do contact us and see what we can do for you to help you educate yourself. Have a great day, guys. Have a great week. And of course, we don't talk to you before the 4th of July. Have a safe and happy holiday with your families. Good day and good night.